Let's take a look at a few more techniques for making short-term strategic business decisions that might come up during your career. Outsourcing decision occurs when a firm has to decide whether it would be better for the firm to make a particular component or handle a specific function like payroll internally, or whether the firm would be better off outsourcing that activity to another firm. This decision has nothing to do with revenues. The firm is going to continue to sell its products or services for whatever seems like a reasonable market price. The issue here is for the firm to choose the option with the lowest relevant cost, that is, the lowest costs that are affected by this decision, subject to qualitative considerations. Would the component have better quality if it was made internally or if it was made by an outside firm? Would an outside firm be able to get the component to this firm on time? And are there any opportunity costs that should be considered? You develop the firm that we explored in the last two sections of this chapter is facing a make or buy decision. It can continue to make its photographic prints in-house, and it's collected some information about the fixed and variable costs of continuing to make the prints. Or it can close its print department and outsource these prints to another firm for 25 cents per print. This decision depends on a couple of factors. First, what is the firm's expected activity level? And second, are there any opportunity costs that the firm should consider? If the firm expects to need 50,000 prints per month, and it continues to make the prints in-house, then its direct materials cost would be 5 cents per print times the 50,000 prints. Its direct labor cost would be 12 cents per print times the 50,000 prints. Its variable manufacturing overhead would be 3 cents per print times the 50,000 prints. Its fixed manufacturing overhead would be the rent, the utilities, and the depreciation, which adds up to $4,000, for a total of $14,000 of manufacturing costs. If the firm decides to outsource the prints, then none of those costs will happen. Instead, the firm would have to pay the outsourcing firm 25 cents per print for the 50,000 prints, for a total of $12,500. The difference between making the prints and outsourcing them is $1,500. In other words, outsourcing decreases the cost of making the prints by $1,500. So you develop should probably outsource the prints. Of course, subject to qualitative considerations, such as print quality, or the ability of the outsourcing firm to deliver the prints on time. or whether you develop can get a price guarantee that the outsourcing firm won't suddenly raise the price. What if you develop expected to need 100,000 prints per month? If the firm continues to make the prints, its direct materials would be 5 cents per print times 100,000 prints. Its direct labor would be 12 cents per print times 100,000 prints. Its variable manufacturing overhead would be 3 cents per print times 100,000 prints. Its fixed manufacturing overhead is fixed. That would still be $4,000 for a total of $24,000. If the firm decided to outsource, of course, all those costs would go away. But now, the firm would be paying the outsourcing firm 25 cents per print for 100,000 prints, for a total of $25,000. The difference between making the prints and buying the prints is $1,000. But in this case, it would cost the firm $1,000 more to outsource the prints to another firm than it would to make them in-house. It's fairly common for firms to find that outsourcing is economically more attractive at low levels of activity, as we saw in the previous example when you develop expected to make 50,000 units, whereas making something in-house is economically favorable if the firm expects to be operating at high levels of activity, as in this example. Based on this analysis, you develop should probably continue to make the prints in-house, subject to qualitative considerations, like the quality of the prints, and whether the firm thinks it's more likely that they will be making 100,000 prints per month or only 50,000 prints per month, and possible opportunity costs. Let's see the effect of an opportunity cost on this decision whether to make or to outsource the prints at 100,000 prints per month. If the firm decides to continue making the prints, then its manufacturing costs would be exactly the same as in the previous example. And of course, those costs wouldn't exist if the firm decided to outsource the print function. But suppose that the firm could use the space that is currently occupied by the print department for some other function that would yield the firm $7,000 a month. In that case, we could consider that the firm is giving up that opportunity by continuing to make the prints. So that becomes an opportunity cost of making the prints. That wouldn't happen if the firm chose to outsource the prints. In this scenario, the total cost of continuing to make the prints in-house would be all of the manufacturing costs plus the $7,000 that the firm is giving up in alternative profit by continuing to make the prints for a total of $31,000. If the firm chooses to outsource instead, then the total cost would be 25 cents per print times 100,000 prints for a total of $25,000. So the difference between making the prints and getting them externally is $6,000. In other words, outsourcing now decreases the cost of 100,000 prints by $6,000. So UDevelop would probably decide to outsource the prints. Subject to qualitative considerations. Here's another way to think about that $7,000 opportunity cost. Rather than considering it an additional cost of making the prints, we could consider it a reduction in the cost of buying the prints. In other words, if the firm uses this space for some other purpose and it gets $7,000 a month from doing that, that would reduce the total cost of outsourcing. That would bring the cost to make the prints down to $24,000. The cost to outsource is still 25 cents per print times 100,000 prints, but the net cost of outsourcing is $25,000 minus the $7,000 that the firm would generate from the freed up space for a total of $18,000. So the difference between making the prints in-house and outsourcing them is $6,000, exactly what we found before, that outsourcing decreases the cost of 100,000 prints. So the firm should outsource the prints, subject to qualitative considerations. For outsourcing decisions, which of these statements is true? Read them carefully and think about which one you would pick. Well, it can't be answer D, because avoidable costs are costs that will be there in one option but won't exist in another option, so they're relevant. And it can't be option A, because opportunity costs also will exist in one option but won't exist in another option, so they're relevant. And it can't be answer C, because we've just demonstrated that the expected activity level is highly relevant. The correct answer is B. The variable costs to produce the product in-house is relevant. Now let's look at a decision that will be familiar to anybody like me who owns an old car, and that is the keep or replace decision, where we have to decide whether it makes more sense for a firm to fix an old machine or buy a new one. In this case, UDevelop is trying to decide whether it makes more sense to repair its old print machine or replace it. Relevant costs of buying a new machine would include the down payment on the machine and the subsequent monthly payments on the new machine, the disposal of the old machine, although the cost of the new machine would be reduced by any salvage value on the old machine, and any difference in the cost of labor or materials or maintenance or quality costs that would occur from using the new machine. Sunk costs include the original purchase price of the old machine, any committed payments for the old machine, and the book value of the old machine. These costs have already occurred, so they should have no effect on whether the firm decides to keep or replace the old machine now. On the other hand, any costs to repair the old machine would be relevant for this decision. The decision rule is choose the option with the lower costs, of course subject to qualitative considerations. In order to decide whether it should keep the old machine or replace it with a new one, UDevelop has gathered some information about both machines. Let's look at each of these costs so that we can help the firm decide whether it's better to keep or replace the machine. The old machine has a book value of $2,100. Is that relevant to the keep or replace decision? No, it's not relevant. The firm already spent that money. No decision that it can make in the present will change that, so it's not relevant. On the other hand, if the old machine has scrap value, that would be relevant. It would reduce the cost of acquiring a new machine. A new machine would cost $7,000. Is that relevant? Yes, it is. If the firm decides to keep the old machine, it won't incur this cost. But if the firm decides to buy a new machine, then it will have to spend the $7,000. The old machine would need $3,500 of repair. Is that relevant to this decision? Yes, it is. If the firm decides to keep the old machine, then it will have to pay $3,500 for repairs. But if it decides to get a new machine, then that cost won't occur. Power for either machine is $250 a month. Is that relevant? No, it's not relevant because it's the same for both machines. The new machine would reduce direct labor costs from $10 an hour to $9.50 per hour. Is that relevant? Yes, it is, because the firm will save 50 cents an hour on labor cost, most likely because the new machine is easier to use, so the firm can use somebody with less experience. Expected output would require 2,000 machine hours for either machine. Is that relevant? It's tempting to think that it's not relevant because the number of machine hours is the same for both machines. But in this particular case, it is relevant because the firm can save 50 cents per labor hour on the wages of the person who is operating the machine. So let's summarize the relevant costs for UDevelop's decision whether to keep or replace their current print machine. If the firm keeps the old machine, they'll pay $10 an hour for their expected 2,000 hours of machine use. But if the firm replaces the machine, they'll only pay $9.50 for the 2,000 hours of machine use. If the firm keeps the old machine, then they'll have to pay $3,500 of repair costs. That won't happen if they replace it with a new machine. On the other hand, if they buy a new machine, it will cost them $7,000. When we add all of the costs to keep the old machine and compare it to all of the costs to replace it with a new machine, we find that the firm would save $2,500 by repairing and keeping the old machine. Subject to qualitative considerations. For example, the new machine may have functionalities that the old machine doesn't have. Or the new machine may waste less of the raw materials. Or it may give better quality prints. Chances are that if these things are true, UDevelop might decide that it's worth paying an extra $2,500 to get the new machine. Remember, numbers advise us, but they don't rule us. Sometimes a firm has to make a choice whether it makes better economic sense to sell a product at an intermediate point in its production or continue to process it further. For example, let's say that a firm owns an apple orchard. They start out with apple trees, and they water the trees, and they fertilize them, and they spray them for bugs, up until the split-off point where they have to make a decision whether it makes more sense to sell the apples or to process the apples into apple pie and applesauce. All of the activities that the firm did up until that split-off point are called a joint process, and they incur joint costs. But once the firm makes the decision to make apple pies and applesauce, they're going to get incremental revenue because apple pies and applesauce sell for more than apples do. but they're also going to incur separable costs, that is, the specific costs to turn apples into apple pies or turn them into apple sauce. Those joint costs of taking care of the apple trees up until the point where they produce ripe apples are important when computing the overall profitability of the firm. But when it comes to the decision of whether it makes sense to turn the apples into apple pie and apple sauce or sell them the way that they are, those joint costs are sunk because they already happened before that decision had to be made. So when a firm is trying to make the decision whether to sell a product at the split-off point or process it further, the incremental revenues are the difference between the sales value of the end product, apple pies or apple sauce, minus the sales value at the split-off point, that is, the sales value of apples. And the separable costs are the costs incurred after the split-off point. The unique costs to turn apples into apple pie or to turn apples into apple sauce. And the decision rule is to process the product further only if the incremental revenues, the increase in the sales value, is greater than the separable costs, what it costs to get there. For example, Apple Delight grows apples from a joint production process that costs $15,000. The firm has a choice whether to sell the apples as they are or turn them into apple pies, apple sauce, and apple juice. What should the firm do? To make this decision, the firm has gathered some data. Let's look at each of their products. When we compare the sales value of the apple pies to the sales value of the apples themselves, we find that turning the apples into pies increases their sales value by $20,000. But when we compare the incremental revenue to the separable costs of making the pies, we find that actually the profit decreases by $5,000. So the firm might decide to sell those apples at the split-off point. When we compare the final sales value of apple sauce to the sales value of the apples from which it could be made, we find that the incremental revenue, the increase in revenue by making apple sauce, is $65,000. When we subtract out the separable costs of making the applesauce, we find that profit increases by $25,000. So the firm would probably decide to process these apples into applesauce. For apple juice, the final sales value of the juice minus the sales value of the apples at the split-off point is $40,000 of incremental revenue, minus the $10,000 of separable costs tells us that the increase in profit from turning apples into apple juice is $30,000. So the firm would probably process these apples further. Of course, these decisions are subject to qualitative considerations. For example, would this firm's customers still buy its applesauce and its apple juice if they can't get apple pies too? In that case, it might be worth it to the firm to take a loss on the apple pies if it encouraged more customers to buy its other products. When managers are trying to decide whether to sell a product now at some intermediate point or process it further, which of these can the managers ignore? That's right. The costs of processing the product up to this point is a sunk cost. The other items are differential. That is, whether they occur depends on the choice that the manager makes. We've said several times that sunk costs are not relevant for short-term strategic decisions. But that doesn't mean that they're useless. Take a minute to watch this video from The Lion King to see how past costs can be useful. This is the end of our work on managerial accounting.